All right, let's get right into it. There's a pretty huge new idea making the rounds, capping all credit card interest rates at just 10%. Now, this is a massive proposal, and it could have some really big consequences for pretty much anyone with a credit card. So, what's the deal here?
So this idea is coming directly from former President Donald Trump. His argument is that credit card companies have, in his words, totally abused the public. So he's calling for this super strict one-year cap at 10%. I mean, for anyone carrying a balance, that number probably sounds like an absolute dream come true.
And just to really understand how dramatic a 10% cap would be, you got to look at this number. Right now, the average credit card interest rate is sitting at around 23.79%. That's more than double the proposed cap. The gap between what's being promised and where we are today is just enormous.
So yeah, on the surface, it sounds like a really simple, straightforward way to give millions of Americans some financial breathing room. But the big question is, what would a policy like this actually do? What are the ripple effects that you don't see at first glance? And that's exactly what we're going to break down.
First things first, let's look at the appeal. I mean, why is this idea catching on? Well, it's because it hits on a major source of financial pain for a huge number of people.
The context here is pretty staggering. According to Bankrate, 61% of people who are carrying a credit card balance, they've been stuck in that debt for a year or even longer. For them, it's not a temporary thing, it's a constant cycle. So the idea of just slashing the interest rate that's keeping them there, that's incredibly powerful.
Okay, but now we have to shift gears and look at the main economic argument against the idea. And this is where things get really interesting. You see, economists don't just see this as a simple cap, they see it as something else entirely.
They call it a price control. It's basically when the government just steps in and sets the price for a good or a service. In this case, the service is borrowing money. And if you look at history, price controls often lead to some very predictable and often not so great outcomes.
Now, a really useful way to think about this is to compare it to something you've probably heard of, rent control. With rent control, sure, it helps the people who already have a cheap apartment, but it can also create a massive shortage of apartments for anyone new trying to move in. Well, the argument is that an interest rate cap would do the same thing. It would help people who already have great credit, but for everyone else, it could create a credit shortage, making it way harder to get a loan in the first place.
And this quote from the source material just brilliantly illustrates the disconnect. I mean, promising everyone a Lamborghini for 10 grand sounds amazing, right? But it completely ignores the reality of what it costs to actually build a Lamborghini. The argument here is that a 10% cap does the same thing. It ignores the real risks and costs that go into lending money.
So, if a policy like this actually happened, who would end up paying the price? Well, the source material suggests it wouldn't really be the big banks, but the very people the policy is supposed to help.
First up, what the industry calls risky borrowers. Now, that sounds kind of judgmental, but it just means anyone with a lower credit score, maybe a shorter credit history, or an income that's not always consistent. From a bank's perspective, lending to them at a capped 10% rate, it just might not be worth the risk that they won't be able to pay it back.
Next, you've got the unbanked. For a lot of folks, a credit card isn't just a convenience, it's a financial lifeline for emergencies. If banks are forced to get way stricter with who they lend to, these are the exact people who could get shut out of the system entirely, and that would leave them with much riskier options when a real emergency hits. And it doesn't just stop with individuals. Think about small business owners. They often rely on personal credit cards and lines of credit to manage their cash flow or invest in growing their business. If banks start lending less money overall, those entrepreneurs are going to have a much harder time getting the capital they need to create jobs and, just survive.
So, what would this actually look like in practice? The prediction is a pretty swift and severe reaction from the banks. They probably start denying almost any applicant who isn't a total sure bet. They might lower credit limits for their existing customers and maybe even close down accounts that haven't been used in a while, all just to cut down on their overall risk in a market that's suddenly a lot less profitable.
Now, to understand why the banks would react so strongly, we kind of have to pull back the curtain and look at the basic mechanics of how the credit card industry is even built. The most important thing to get here is that credit card debt is unsecured debt. See, unlike a car loan or a mortgage, there's no thing for the bank to take back if you don't pay. They're lending you money based purely on your promise to pay it back, which, when you think about it, is a really risky business.
And that risk creates this really fascinating system of internal subsidies. Basically, the high interest that some customers pay is used to cover the total losses from other customers who default and never pay their bill. But it goes even deeper than that. The interest paid by people who carry a balance from month to month, that's what actually pays for all those lucrative rewards points and cashback programs for the people who pay their bill in full every single month. If you cap the interest rate, you throw that whole balancing act into total chaos.
So given all these economic arguments and potential consequences, what's the final take on this whole proposal? Is this a serious plan for the economy, or is it something else entirely?
Well, the source material pretty much concludes that this is way more about politics than it is about sound economic policy. It's a simple idea. It sounds great, and it really resonates with voters who are feeling squeezed financially. That makes it a super effective talking point, whether or not it's actually workable in the real world.
And, let's be honest, it's easy to see why these companies are a target. Just look at these profit margins. They're incredibly high. But the source argues that even if you think these profits are totally excessive, using a government price control isn't the right tool for the job, because it just ends up distorting the whole market for everyone.
So instead of a cap, the source floats some other ideas that focus more on financial education. Like, what if you had to pass a basic financial literacy test before you could even get a credit card? The thinking there is to make sure people fully understand the tool they're about to use instead of just trying to change the tool itself.
And that leaves us with a final and most critical question. A 10% cap might just be a political talking point with some pretty serious potential downsides. But the problem it's trying to fix, that crushing consumer debt, is very, very real. So if this isn't the answer, what is?